It's fascinating how companies navigate the complex world of stock markets, especially when they hit a rough patch. One strategy that's been gaining traction is the reverse stock split. You might be wondering, why would a company do this? Well, the primary reason is to boost its stock price to meet minimum listing requirements. Many exchanges, like the NYSE or NASDAQ, have a threshold, often around $1. If a company's stock falls below that, it risks being delisted, which can be catastrophic for its reputation and investor confidence. So, what happens in a reverse stock split? Essentially, a company consolidates its shares. For example, in a 1-for-10 reverse split, if you owned 10 shares at $1 each, you'd now own one share worth $10. It sounds like a neat solution, right? But here's where it gets tricky. While the stock price may rise on paper, the underlying issues that cause the decline often remain unaddressed. Investors might initially react positively, thinking, wow, the stock is now above $1. But the reality is that a higher price doesn't equate to a healthier company. It's like putting a fresh coat of paint on a crumbling building. The structural problems are still there, and eventually, they'll show through. Moreover, reverse stock splits can create a perception problem. Investors may see them as a red flag, signaling that the company is in trouble. It's a bit like a warning sign flashing in neon. When a company resorts to this tactic, it can lead to a loss of trust. Investors might start to wonder if management is trying to mask deeper issues rather than addressing them head-on. And let's not forget about the psychological aspect. A stock that trades under $1 often attracts a different type of investor, those looking for a quick flip rather than long-term growth. Once a reverse split occurs, the stock might lose that speculative interest. The trading volume can drop, making it harder for the stock to recover. In many cases, companies that implement reverse stock splits end up seeing their stock price decline again shortly after. It's a vicious cycle. The initial boost can be short-lived, and without solid fundamentals to back it up, the stock can plummet back down, sometimes even lower than before the split. Take a look at some high-profile examples. Companies like Citigroup and AIG have used reverse splits in the past, but they still faced significant challenges afterward. It's a classic case of trying to put a Band-Aid on a bullet wound. In the end, while reverse stock splits might provide a temporary fix to stay listed, they often backfire. The key takeaway here is that a stock price is just a number. What truly matters is the company's performance, its ability to innovate, and its overall health. Investors need to look beyond the surface and focus on the fundamentals. Otherwise, they might find themselves caught in a cycle of disappointment, watching as the stock they thought was on the rise takes another tumble.